Well, good morning. It's me, Kenny Polcari, your host of the party. And look at this spectacular day here on the Cape. The sky could not be bluer. The water behind me is blue and calm, and the sun is shining. So today is Friday, July 28th, 2023. And here are the things you know as we head into the end of the week. So the historic Dow bull run comes to an end, right? And all that means, as if that means anything at all. To me, it meant nothing, but the media was making such a big deal about 13 straight days. Who cares? Stronger U.S. eco data fuels speculation of more rate hikes. The Bank of Japan surprises investors and the markets by becoming more hawkish, and stocks took a punch in the gut. The 10-year yield surged up and through 4%, and the 2-year followed as well. Next week, we're going to get more tech earnings as we head into the second half of earnings season. And what do we have for dinner? Well, we're having it tonight, tomorrow. It's the weekend. It's summertime. It's the beach. We're going to have the Simple Steamed Lobster with drawn butter and plenty of corn on the cob and coleslaw. Okay, so let's go back to the markets. This 13-day historic bull run, which I think was nothing but drama, for the Dow came to a crushing defeat on Thursday. Stocks, which wanted to go higher early in the morning, finally succumbed to the pressure of it all at about 1:30, right? Now, in the morning, we got a stronger second quarter GDP. We got better pending home sales. We got a strong durable goods report and a stronger retail inventory read, all suggesting that the Fed might have managed a softer landing despite the fact that they've also pushed rates to the highest level in 22 years. And that's good, but it only fuels speculation that the Fed's not done yet raising rates. Remember, JJ has to see the economic data weaken, not strengthen. And that led to surging bond yields. The 10-year went from 3.87 to more than 4%, while the 2-year went from 4.85 to 4.93. Then toss in the rumors that the Bank of Japan, it's no longer a rumor, in fact, it's fact now, but yesterday it was a rumor, that the Bank of Japan was about to let their rates rise more than expected. That's hawkish, and that caused a late afternoon angst and sell-off in stocks. So think about this. Could it just be that investors were tired and that the rally ran out of steam? Yes. I mean, just look at the chart. The Dow's up 6% over the last 13 days, which is a substantial move for that index in that short period of time. Could it be that the strong economic data suggests that the Fed is not done yet raising rates? Well, of course it could. And then could it be that late afternoon rumor that the Bank of Japan was going to tweak their yield curve control mechanism more than the expectation? Could that be the reason for the late day sell-off? And yes, again. So it's yes, yes, and yes to all three questions. The issue here about the Bank of Japan is higher yields in Japan, right? They're currently negative 0.5 to positive 0.5 within that range, right? The YCC controls it within that range. But the overnight move essentially allows them to tolerate a 10-year bond with a 1% yield, which means that they effectively raised rates by 50 basis points without really saying it. These higher yields could see Japanese investors repatriate cash, bring it home, which is what caused the anxiety. And how would that do, right? They would sell their U.S., European, Australian bonds and equities. And why is that an issue? Because Japanese investors are the biggest foreign holders of U.S. assets, and they're pretty big in Europe and Australia as well. So if they repatriate their cash, that would put pressure on assets as they would become sizable sellers of those assets. And here's where I call bullshit. While we may see some of that, there is no way that these Japanese investors are taking all their money and then running away to go home to 0% rates or 1% rates. Come on. And by the way, there's also no way that they're selling all their U.S. assets. They're just not gonna. But the issue is that the Bank of Japan surprised the markets by making a bigger or more hawkish move. But this too is gonna settle down, right? So stop the histrionics. And by the way, aren't we all hoping for a little something to shake the branches to see who falls out of the tree? I mean, I know I am. What about you? And so what did we really see? The markets didn't crash. It wasn't the end of the world. The Dow fell 240 points, or 0.7%. The S&P lost 30 points, or 0.6. The Nasdaq lost 77 points, or 0.5%. The Russell gave up 25 points, or 1.3%. And the Transforms gave back 213 points, or 1.3%. Hardly anything to write home about, and hardly anything that would cause you to change your plan. All of the U.S. indexes are higher by double digits, with the exception of the Dow, which is up 6.5% year to date. But the rest of them are up double digits. Now, we're halfway through earnings season, and guess what? We haven't really been disappointed, right? In fact, we've been a little bit more surprised than not. 81% of the companies reporting have beaten the estimates. Guaranteed, understood that they've been lower estimates, that they've beaten them while they're offering better forward guidance. Now, I don't expect this to change during the second half of the reporting season, which doesn't mean we won't see the market back off, but nor does it mean we'll see the market push ahead, right? What it does mean is that you just need to remain dynamic, right? You should only rebalance your portfolio if you must, or just allocate new money to the sectors that have been underperforming, right? Because by allocating money to the underperformers, you're actually rebalancing your portfolio anyway. Gavish, as a long-term investor, it is not your job to try to pick tops and bottoms. No, that's a day trader. Let them do it all day long. You are trying to build a strong portfolio that's going to weather the storm if we even have one. And we will at some point. So you just want a strong portfolio. Eco data today is all about the core PCE deflator, the Fed's favorite inflation gauge. So what's that going to tell us? The PCE month over month is expected to rise by 0.2, year over year up 3%. The core PCE month over month is expected to be up 0.2, while the year over year is expected to be up 4.2%. All of these numbers are better than last month if they come in as expected, and that's exactly what the markets are looking at. In any event, unless they are substantially better, I do not think it changes the story at all. This one data point is not going to suddenly cause a shift from hike to pause. We're going to have to see all of the eco data over the next 8 weeks to weaken in order to see a shift from the current higher rate narrative to a pause narrative. In addition, we're going to watch for personal income and personal spending, expected to be up 0.5% and 0.4% respectively. Employment cost index up 1.1%. University of Michigan sentiment survey holding steady at 72.6. Of the 11 S&P sectors, only one was up yesterday, and of course, unless you consider the contra trades as being a sector, because they were up as well. The best performer yesterday was communications, the XLC up 0.8, and you can thank Meta for that. I pointed this out in yesterday's note. Recall I told you that Meta makes up 25% of that ETF, and yesterday Meta was up 4.4%, enough to carry the whole index higher. The stocks, the semiconductors, were also higher, up 1.8% ahead of last night's Intel report, which was better than expected. They finally turned a profit. Imagine that. Intel's up 6% this morning in the pre-market. The contra trades yesterday were also winners. The PSQ was up 0.3, the SH was up 0.6, the DOG was up 0.7%, and the VIXI, which is the fear index, shot higher by 5.5%. That was the clear winner. The worst performer, real estate, down 2.1%. Utilities, down 1.7%. Now, you have to think about higher rates will continue to hurt utility yields, right? Utilities spin off about 4% on average. After yesterday's action, bond yields in this country are expected to go higher. So if you're concerned about equity prices but want guaranteed yield, you're going to take your money out of utilities, which are boring and defensive and safe, and you're going to put it into bills and bonds that are yielding into the mid-5s, right? Those are the shorter duration bills, the 3 and 6 months, or the high 4s, the 2-year bonds. Financials, XLF, also took a hit, falling 1.2%. Consumer discretionary lost 1%. Staples, healthcare, energy, industrials, basic materials, and tech all lost less than 1%. So it wasn't a disaster across the board by any stretch. U.S. futures this morning are up, bouncing after the hit they took yesterday. Dow futures are up 50, S&P's up 15, Nasdaq up 110, the Russell's up 7. 6 companies have reported so far. CNC beat, ARCB missed. Aon and AVTR missed, Chevron beat, while Exxon missed, just slightly. We're still waiting on Colgate, Procter & Gamble, Newell, and T. Rowe Price, and a few others. European markets this morning are lower as the week comes to a close. Earnings and central bank policy decisions are weighing on investors as the final bell for the week approaches. While the BoJ policy decision yesterday was seen as an issue, there isn't any panic about it today. At 7 o'clock this morning, all the markets across the zone were between -0.3% and +0.1%. Nothing dramatic at all about how markets are responding. The dollar index surged higher yesterday to end the day at 101.77, but it's retreated just a bit this morning and is trading at 101.61. The sense is that if the Fed does nothing, then the dollar should weaken. But the recent action yesterday suggests that that's maybe not the case. Oil's holding steady at 79.90, while gold took a hit yesterday on the back of those rumored coming rate hikes. So it sent gold down about $30 to the 1980 level once again. This morning it's stabilized and it's up about $7 at 19.92 an ounce. Remember, I am not in the camp that the Fed is done. I am expecting rates to continue to be pushed higher. Maybe one more time, maybe two more times. But I think the sweet spot is 6%. And we're 0.5% away from that. The S&P ended the day at 45.37. The Dow was down. The S&P was down 30 points. Futures are looking up this morning on what feels just like a knee-jerk reaction to the pressure from yesterday. I've been saying that I think the market's tight, and I still think it is. I still expect it to back off, but I'm not going to complain if they push it up. Why? Because I'm invested, and I'm invested in the names that are moving, right? Techs, banks, consumer staples, SMIDs, communications, and value names, all moving nicely higher. So I'm there, so I'm not complaining. They want to push the market up? Rah, rah. Yesterday, I said, don't get lulled into this sense of never, never land, because never, never land does not exist. At some point, investors are going to recognize that the market's a stretch, valuations are stretch, and that it's going to need to take a breather. And it will, but that will give the long-term investor a gift, right? You shouldn't be chasing the names that are running away. I've talked about this for weeks now. There are plenty of other options and opportunities that will help you balance out and stabilize your portfolio for the longer term. Patience, in this case, is a virtue. And remember, investing is a long game. It's not a day trader's game. Investing is a long game. Okay, so now you can see the day is absolutely gorgeous. The tide, the water is calm. The tide is coming up. So what are we having for dinner tonight? We're having the Simple Steamed Lobster, just with drawn butter. There's nothing complicated about this. Anyone can do it. And if you get the nice, sweet lobsters, there is nothing better on a late Friday afternoon or Saturday afternoon, right? We're just going to steam. We're going to steam/boil them. You're going to have plenty of drawn butter. You're going to have corn on the cob. You're going to have coleslaw. It's going to be a real kind of summer day. Put the picnic table right out by the water. Even put it down on the beach if you want, right? For this, you need like 1.5 pound lobsters. That's really the perfect size for people to eat. Anything bigger is bigger, and they tend to get tougher, right? You want plenty of butter, you want coleslaw, and you want plenty of corn on the cob. So using your turkey fryer, right, the thing that you put your turkey in at Thanksgiving, you're going to fill this turkey pan with water. You're going to put it on the gas, and you're going to bring it to a boil. You're going to drop the lobsters in the water head first once the water starts to boil. Then you're going to count 8 minutes for the first pound and then 2 minutes for every pound after the water reboils. In the meantime, you're going to melt your butter. You're going to place it in bowls that you can share. Once the lobsters are done, remove them, present them on a large platter, and allow your guests to help themselves. Have the nutcrackers on the table to help crack open the claws to get the meat out. Separate the tail from the body by breaking it apart, right? Remove the fins at the bottom, and then use your thumb and push the tail meat up and out to enjoy, right? And then cut it up, dip it in the drawn butter, look out at the ocean, grab a bottle of ice cold beer. It is the perfect weekend dinner, especially when you're at the beach. In any event, look at this day. I hope this day portends about what it says for the markets. Because remember, yesterday, when I was out here, the sky was cloudy, the wind was picking up, the oceans were rough, and look what happened to the market. It sold off. Today, it looks like a perfect day. So maybe we'll see the markets rally again, right? And everyone will be happy. In any event, I'm on vacation next week, right? I will not be writing a note for the whole week, so I will see you the week after. So what's that, like August 7th, I guess. In any event, feel free to always contact me. You can get me through my website. You can get me on Twitter, get me on LinkedIn. I'm always happy to talk about the markets. But until then, take good care.